Hello, everyone, and welcome back to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president, and it's my privilege today to introduce our speakers for our semi-annual Global Economic Prospects event at the Peterson Institute, led and coordinated by Karen Dynan. We have three great speakers today: Karen, non-resident senior fellow Alejandro Werner, and returning full-time senior fellow, I'm delighted to say, Arvind Subramanian. We will be doing this totally on the record. Registered Zoom participants can file questions to be asked to the speakers during the discussion using the Q&A tool on Zoom. The Institute, as I hope many of you know, has for a long time now been doing these semi-annual global economic prospects, wherein we assess a deep dive on the U.S. economy, as well as a look at the key large economies in the G20. We intentionally do this a little ahead of when the IMF releases its World Economic Outlook, and not stepping on the toes of the OECD and World Bank and other such organizations, because we wish to be an independent voice in the dialogue. We are not an investment bank. We do not have a huge staff doing this. What we do have is, like Arvind and Karen and Alejandro, a number of experts on various countries' economies who coordinate and provide their best guess forecasts for real growth over the next couple of years. This is a collection of individual views from Peterson Institute scholars, which Karen curates as well as guides. With that, today, again, let me introduce our distinguished speakers. Karen Dynan, who is a professor of the practice at Harvard University Economics Department, has been a non-resident senior fellow and leader of our Global Economic Prospects since March 2017. She served as Assistant Secretary for Economic Policy and Chief Economist of the U.S. Department of Treasury in President Obama's second term from 2014 to 2017. Prior to that, from 2009 to 2013, she was Vice President and Co-Director of the Economic Studies at Brookings. Karen is a noted scholar of savings behavior in the U.S., as well as on household finances and macroeconomic forecasting. And we're very proud and grateful that she continues to lead our efforts. I also want to reintroduce Alejandro Werner, who is a non-resident senior fellow at the Peterson Institute since a year ago, and is the founding director of Georgetown University's Americas Institute. He had a distinguished period of service as director of the Western Hemisphere Department of the IMF from January 2013 to August 2021. In addition, he had previously served as Undersecretary of Finance and Public Credit and Director of Economic Policy and Chief of Staff at Mexico's Finance Ministry, and prior to that as Director of Economic Studies at the Bank of Mexico. So he's a distinguished public servant as well as scholar, and we're very proud to have Alejandro be part of our team working on Latin America, as well as our colleagues Jose de Gregorio, Monica de Bola, and others. Finally, it's a personal pleasure for me to welcome back Arvind Subramanian as a full-time, therefore resident senior fellow at the Peterson Institute. As many of you know, Arvind served as a senior fellow, including as the Dennis Weatherstone Senior Fellow from 2007 to 2014, at which point he became Chief Economic Advisor to the government of India during President Modi's first term. He served 4 years in that position and was quite forthright about the realities of the Indian economy, and continues to be a leading public voice on Indian political economy, economic issues, as well as on global trade and development issues throughout the world. Previously, before returning to the Institute full-time this year, he was a senior fellow at the Watson Institute for International and Public Affairs at Brown, and a distinguished non-resident fellow at the Center for Global Development. He's also been a visiting lecturer at Harvard Kennedy School and a professor at Ashoka University. He continues to advise the government of the Indian state of Tamil Nadu on macroeconomic and sectoral issues. So with that, let me step back and ask Karen Dynan to take us through the Institute's global forecast and her deeper analysis of the U.S. economy.
Thank you, Adam, for that introduction. I'm going to share my slides. Okay. All right. Hello, everyone. So this is a forecast that calls for a soft landing in most countries from the high inflation of recent years, but there is also important downside risk, which I will cover at the end of the presentation. So I am, too many slides. I am projecting a further moderation of global real GDP growth next year because of restrictive financial conditions. But as you can see in this graph, it's not a collapse in economic activity. I just have growth dialing back from 3% this year to 2%, or sorry, to 2.8% next year. Now, of course, inflation has been an important force shaping global outcomes in recent years. As you can see in this slide, the encouraging news is that inflation, even core inflation on the right, is subsiding. Yet at around 4 or 5% on a 12-month basis in many countries, inflation still has some distance to go to get to central banks' targets. And probably the easier part of the disinflation is behind us. So central banks have, as we all know, raised their policy rates sharply over the past 2 years. But as inflation sinks lower, we will see central banks reach the end of their tightening cycles. And in fact, some emerging market economies like Brazil, you can see on this graph, are already beginning to lower their policy rates very gradually. The rate hikes have left financial conditions very tight in many economies. As you can see in the left graph here, long-term interest rates are on average at the high end of their range over the past 15 years. And on the right, in the United States, the Fed's Financial Impulse Index, which takes into account kind of all sorts of dimensions of financial tightening, shows financial conditions dragging on growth by about 2/3 of a percentage point over the coming year. So probably other central banks that have done the same thing as the Fed has done are in a similar situation. And I will say financial conditions are likely to remain pretty restrictive over the next year, as widespread rate cuts are unlikely. Economic outcomes will vary across the large advanced economies, depending on the specifics. But if you look across countries, you see the slower growth going forward. In the United States, monetary tightening and related fallout is the main story. I'll talk more about that in a minute. Europe has weaker underpinnings, and some of the European countries are in modest recessions. They'll probably pull out next year, but still it's a fragile recovery for Europe. Japan, in contrast, is having a moment with surprisingly strong growth this year, given a surge in tourism after a delayed reopening from COVID. I expect growth to dial back a bit next year, but be pretty solid. And the UK has likely entered a mild recession, given monetary tightening and other sources of drag, including lingering issues related to Brexit. Growth prospects also vary across the big emerging market economies. The Chinese economy, on the left side of this picture, continues to be weighed down by further property crisis effects, weak consumer demand, and unsustainable local government debt, albeit partly offset by some modest stimulus measures in China. Arvind, as Adam said, will talk later about the mostly solid prospects for India. I do expect a bit of deceleration. In Russia, fallout from the Ukraine invasion continues to weigh on that economy. And on the right side of the graph, Brazil has performed better than expected, but we think is still being held back by structural problems. And Alejandro will have more to say about that in a minute. This slide just has our global growth numbers. If you want to come back and take a look at it, it's the same thing that was in the graphs. Let me turn now to a deeper dive on the United States. As you can see here, my forecast calls for below trend growth in real GDP. You can see that in the graph. That keeps outlook below potential, but it's not negative growth. So it's basically a soft landing for the United States. As background, US growth has been surprisingly strong to this year, which with what looks like maybe an acceleration in Q3, but I do expect a lull in Q4, given some combination of the UAW strike, the restart of student loan payments, and a probable government shutdown. But then I expect growth to resume next year at a pace that's about 0.5 percentage point below its trend pace. So it keeps the level of GDP below the potential level. My optimism about a soft landing is based on several factors. So first, the labor market is rebalancing in the United States. On the left, you can see more supply has come online, with the prime age labor force participation rate now having risen above pre-pandemic levels. I'm not showing it here, but the pandemic shortfall in foreign-born workers is now gone, so that's helping too. On the right, you can see that employment growth has slowed, just as policymakers hoped it would, but it's still at a healthy level. This graph includes a dashed line, a dashed black line, showing what I view as the neutral employment growth rate. And that's the rate where the unemployment rate would stay constant. And what you can see in this graph is that the current level of employment growth is still above that neutral rate. You can see in this slide on the left that an important direct measure of slack, job openings relative to unemployed persons, is coming down, having retraced about half of its run up relative to pre-pandemic levels. So that's good. Slack is increasing. And importantly, job openings have declined without a big run up in the unemployment rate thus far. The graph on the right is everyone's favorite beverage curve graph, showing job openings plotted on the vertical axis against the unemployment rate on the horizontal axis. And people have made what I thought were pretty compelling arguments that we would be likely to shift back along the gray curve, which was the most kind of recent data during the pandemic, with unemployment rising as job openings fell. But as you can see by the red points on that graph, which are the more recent data, openings are declining without a big increase in unemployment. So we should be optimistic that we might, that we'll be able to see an increase in slack without much of an increase in unemployment. Now, consistent with this increasing slack, wage and compensation growth are subsiding, as you can see in this graph. It's a gradual process. It's not coming down really fast, but particularly the 3-month change in the employment cost index, the ECI, which we think is the better indicator, has been promising. The next ECI release is not for another month, but it will be a very important indicator to watch. Core inflation is also falling. I'm showing the PCE price measure here since we think it better captures inflation. These numbers are a bit dated. They're numbers for July because the PCE price information for August is not yet available. But based on the CPI for August, the trends look promising. And I put both 12-month growth rates and 6-month growth rates on here. The Fed has indicated that it is watching those 6-month growth rates particularly closely. So certainly the news has been good in terms of a deceleration of prices for core goods, panel on the left. We are also finally moving in the right direction for core housing. You can see that measure has come down quite a bit from the peak. And on the right, I have super core, which is core services excluding housing. It constitutes about half of core inflation. It's also coming down, albeit more slowly, like wages. There has also been good news about inflation expectations. Household inflation expectations have really subsided. You can see that on the left side of this chart. And financial market-based expectations, so based on TIPS rates, are about half a percentage point above where they were pre-pandemic. That's not great news, but if you look at just the level, the magnitude of how much the increase it is, I find it hard to get too excited about a magnitude increase of this size. Anyway, this all leads me to the view that inflation is moving in the right direction. It's still too high, and I think the Fed will have one more hike in December, and that rates will then stay at that very elevated level until next fall. But then with a further easing of 12-month core inflation to below 3%, so that's about a percentage point from where we are now, we will see the Fed begin to gradually back off the high rates. The slide also shows my inflation and unemployment rate forecast with core inflation of 2.8% at the end of next year. So that's a deceleration of about a percentage point, and the unemployment rate moving up to 4.2%. Thinking a little further ahead, I'm not presenting forecasts for 2025, but just to think further ahead, I will say that bringing inflation all the way back to target is likely to take some time. Even with rate cuts starting at the end of next year, I think restrictive financial conditions are going to be with us for some time. And you can see this in the Fed's forecast for the policy rate, which is on the left. The red line is their most recent forecast, and in market expectations, which you can see it on the right. You can see that rate cuts start next year, middle or late next year, depending on who we're talking about. But the downdrift from there is fairly gradual, and even by the end of 2025, rates are well above where they were pre-pandemic. So I don't have a 2025 forecast for GDP growth, but if I did, it would show below trend growth as well. Now, I want to spend my last few slides on risks to this outlook. I think the risks are large, and I think they tilt to the downside. So what I'm going to do is I'm going to highlight three risk scenarios. The first is a scenario of sustained overheating. The issue is that households saved a lot during the pandemic because they had reduced consumption and they had income support. We don't really have the micro data to tell us how much of that excess saving is still left. We think households have been spending it, but we don't really have the micro data to tell us how much remains. So we're hearing commentators who are making assessments of how much excess saving is out there based on simplistic exercises where people compare the aggregate saving rate relative to some concept of normal. And what I'm showing you in this graph here is that depending on what you're thinking about normal saving is, you can get widely different conclusions about what excess saving might be, all the way from people are out of excess savings, it's at 0, to we still have excess savings of about 5% of GDP. So in this scenario, we have large remaining excess savings, some lingering pent-up demand. We've got strong labor market supporting income, and you get underlying demand that's stronger than the current consensus, in which case the Fed may need to tighten further, which increases the odds of a hard landing. A second risk scenario is one of global malaise. As I talked to different experts at the Peterson Institute and elsewhere about prospects for different countries, most people thought there was a good case for the soft landing scenario. Economies continue to muddle along with below trend growth next year, but I heard a lot about downside risks from a lot of people. So those risks include the fragility of the European economic situation. So maybe that economy slips into recession. The weakness in China, that weakness would be expected to have spillovers to the rest of Asia. and a banking sector in the United States that is suffering from what one might call a slow burn from commercial real estate troubles. The acute part of any banking crisis is behind us, but as commercial real estate leases turn over, we expect to see more defaults and delinquencies, which are going to be tough on the banking sector. So this global malaise scenario, it might be good news for inflation, but the risk is that the Fed and other central banks may not be able to cut rates quickly enough to avoid recession. And then the last risk scenario I want to highlight is the one that I think might be the most challenging, and that is that inflation could materially reaccelerate if developments in global commodity prices push up energy and food prices, or there's another significant disruption to supply chains. I don't think this is a high, I don't think there's a high odds of this scenario playing out. You can see the graph I put in here of oil prices and the kind of moderate rise we've seen in recent weeks. I don't think that's enough to tilt us into the scenario. We need something much more dramatic to happen. But I think it would put central banks in a position where they had to raise rates higher amid economies that were already weakened by the shock. So it would be the most challenging of these scenarios. So that's all I have. I will stop sharing and turn things over to Alejandro, I think.
Thanks, Karen. Thanks, Adam, for the introduction. Let me move through my presentation. Let me, okay, here we go. So after growing at 7% and 4% in 2021 and 22, Latin America GDP, average GDP growth is expected to be around 2% in 2023 and to slow down below that, maybe close to 1.5% in 24, as both its biggest economies, Brazil and Mexico, are expected to slow down next year. This year, we saw significantly better than expected outcomes in GDP growth, both in Brazil and Mexico, than what we expected at the beginning of the year. I would say in Mexico, that was on the back of a better US economy. I think Mexico having not done an important COVID stimulus package. The post-COVID recovery is moving slower than the rest of the world, and therefore we still have some pickup from there. And maybe there's some nearshoring effects, both on exports and on investment showing up. The Brazilian economy showed up to be more resilient than what we thought to the increase in interest rates. The fiscal stance was looser than expected, and also the agricultural sector had a great year. Chile is the only country having a recession this year from this small sample of the large economies in LATAM. Obviously, we're not talking about Argentina today. We will just mention a little bit on the elections. Chile is on recession basically due to the large policy contraction, both on the fiscal side and the monetary policy side, something similar going on, explaining the slowdown in Colombia. And Peru, in addition to policy tightening, some El Niño effects are starting to show up and will weigh in the rest of the year. And also, I think policy uncertainty finally is showing up after 7 years with 7 presidents in which kind of the decoupling between the politics and the economics perplex a lot of people. I do think that potential GDP in Peru is coming down, basically on the back of significant policy uncertainty. Let me move to the next slide on fiscal. The correction of the fiscal stance after COVID has been much faster in general than we all expected. That and obviously inflation helped to moderate the expected increase in debt to GDP ratios, but going forward, I think we still have significant fiscal adjustment to be done so that we reach debt stabilizing primary surpluses in the region, and that's going to be an uphill battle. I think projected consolidation in Brazil will move slower than expected. the recent budget in Mexico signal a changing trend from the López Obrador administration with a much higher deficit than what we expected for the last year of that administration, and therefore posing important challenges for next government. And obviously the combination of difficult political situations, economies that are back to mediocre potential growth of around between 2 and 2.25% will make fiscal consolidation a challenging task in Latin America. Turning to inflation, I mean, headline and core inflation has come down in most of the country. I would say that except Colombia, the turnaround in inflation has been pretty clear. It also shows up in services a little bit less in core services inflation. But I mean, Latin America acted earlier than the rest of the world with a stronger coefficient on inflation deviations, let's say in their Taylor rule than other countries. And inflation expectations has been, especially medium-term inflation expectations, relatively anchored. We see the case of Chile, where anchoring was complete, the yellow line on the left-hand side. The case of Mexico, I would say the anchoring was pretty good. This deviation between medium-term inflation expectations and the mid-range of the inflation target at 3% has been there forever. So one should accept that the de facto inflation target for Mexico is somewhere around 3.5%, 3.3%, rather than the 3%, than the official 3%. And there has been some slight increase in Peru's medium-term inflation expectations. And Colombia, it's a shorter horizon inflation expectation because the central bank doesn't publish longer-term inflation expectations. It's a little bit more unanchored. And that is why I do think that as it has already happened in Chile, Peru, and Brazil, it is time to loosen the excessive tightening in monetary policy. I think Colombia should wait a little bit more, but I think there's also space in Mexico for Banco de Mexico to start moving. Their talk is that there will be no move for the rest of the year, although I think conditions warrant a loosening of monetary tightening to somewhere more normal, tighter monetary conditions in Brazil, Chile, Mexico, and Peru. When we turn to politics, important elections in Argentina, Ecuador this year, and Mexico next year. In Argentina, I would highlight that the important economic effect is that we might have expected each time we have a Peronist government present in a tight election for elections to be stabilizing, because the expectation of a new political party coming in that will be more rational on the macroeconomic policy proposal will generate expectations of stability, or at least less instability in the economy. It is not showing up this time. Why it is not showing up this time? On the one hand, because the finance minister is the current candidate from the Peronist party, and policies have turned extremely expansionary, completely deviating from the IMF program that they recently signed their last review 3 weeks ago. They have completely deviated from that. But in addition to that, one of the candidates that has today the largest probability of becoming the president, proposing a dollarization plan for an economy that doesn't have dollars, that has negative net reserves, is generating expectations that if the urgency to dollarize is very high, that should happen after a significant burst of inflation. So that's in Argentina. I would say in Ecuador, the true question will be the level of governability that the next government will have. Guillermo Lasso is leaving early, not to be impeached. He called this a special feature that they have in the Constitution, in which both presidential term and congressional term are cut earlier, and they call an early election for both of them. And I think the important thing is if the next government will have significant support to do the fiscal consolidation that they have. And we have the two candidates are two women, running for the continuation of the López Obrador project with Claudia Sheinbaum, or Xochitl Gálvez leading an alliance of the opposition. Significant challenges for the next government, both in having a fiscal reform at the beginning to make public finances sustainable for the next 6 years, important energy reforms, both on electricity to allow for an increase in supply of renewable energy to support the incoming investment from the reallocation of firms from, let's say, from China. And third, security issues deepening in Mexico and making it an important challenge of the next administration. The possibility of having a third candidate would significantly, I think, increase the probability that Claudia Sheinbaum wins the election, and therefore we will have a continuation of the current government program. I mean, the main issue for Latin America has been the lack of productivity. When you look at the huge deviation between growth path in Latin America, emerging Asia, and productivity levels, that signals a great challenge that Latin America has for the medium term. A recent G30 article touches upon these issues. I mean, on the one hand, now we're facing significant polarized societies, limiting the capacity to do significant reforms. On the other hand, I think there's two important external factors supporting Latin American growth. One is the energy transition, Latin America being abundant in renewable energy, in lithium and in copper, and this process that has been called nearshoring, basically affecting Mexico, a little bit Central America, and maybe Colombia, that the reallocation, I mean, given geopolitical tensions between the US and China, significant reallocation of firms from Asia to Latin America, especially for Mexico. However, I think it's important to highlight that in the last important export booms that we saw in Latin America, one associated with NAFTA, that is the one that we had on the left in the case of Mexico with exports, that the one we have on the right for Mexico, export increasing by around $100 billion, did not trigger a convergence process to advance economies' income per capita levels. And the same is true with the commodity boom affecting South America, with a significant increase of around $500 billion in exports for Latin America, generating an important step up in GDP, but with almost negligible effects in potential GDP growth. So from a medium-term perspective, this time Latin America will have to do significant reforms to change this process, if it happens, into a process in which significant changes in the medium-term rate of GDP growth will happen. And for that, an ambitious agenda of structural reforms will be needed. I'll stop here, and we will move to the presentation by Arvind.
Thanks, Adam, for the kind introduction. I'm delighted to be back to the Peterson Institute as well. Let's plunge into the outlook for India, both for the short term and the medium term, which is perhaps even more interesting because all the buzz about India is about its promise in the long run, especially in the context of a possibly declining China that Adam and others have written about recently. So as for the short term, there is a little bit of a puzzle interpreting the data. The recovery from the pandemic was really robust, but the signals are a little bit confusing now. And this chart shows a real growth rate in the black and nominal GDP growth rate in the red. And essentially, the real GDP growth shows a kind of, after a robust recovery and a small decline, an economy that's been accelerating from 4.5 to 6 to 8%, which is the most recent, 7.8, which is the most recent reading. However, if you look at the nominal growth numbers, it shows a decline, sharp decline from 22% to 8%. So the question is, how do you interpret this? Normally, of course, we would look only at the real numbers because that's what's measuring the real economy. But the problem is that the real number is subject to deflator measurement issues. And as you can see here, the GDP deflator in the red has shown a kind of wild swing from 11.5% in the first half of fiscal 23 to it's almost like a 12 percentage point swing in the GDP deflator. And that's because the GDP deflator is unusually weighted by food and fuel, which swings enormously due to international prices. So our best estimate is that if you look at the inflation data and the measurement challenges in the GDP deflator, it seems like the economy is probably decelerating rather than accelerating, as the official number seems to suggest. And if you look at some other high frequency indicators, exports, tax revenues, etc., the picture is also point to a deceleration. The two major exceptions, of course, bank credit has been strong because India has finally come to grips with the NPA problem in the banking system, and residential real estate is also doing very well. So apart from these sectors, overall, the data do seem to point to deceleration, which I think we should keep in mind when one assesses the short term. The recovery from the pandemic was driven by exports, especially services exports, very robust government investment, and a pickup in residential real estate. However, the outlook must remain cautious because oil prices are rising again. India is a net importer of oil. As Karen pointed out, the global economy is softening, and that's already getting reflected in Indian exports of services, which the latest data show is in negative growth territory in nominal dollar terms. The agricultural outlook, as you know, India, 18% of output still comes from agriculture. This year's monsoon has been very erratic. Bad June, good July, very bad August, better September, and so on. Therefore, the outlook and reservoir levels have been depleted. So it looks like, the agricultural outlook is a bit uncertain, maybe a bit weak even compared to long-term average. And labor markets are also fairly soft. The best indicator of this is the demand for the nationwide rural employment guarantee scheme, where the demand is about 30% above normal. All that said, of course, international investors are extremely optimistic, even bullish about India. JP Morgan has just announced that India will be added to its emerging markets bond index, I think, beginning next year. So I think the short-term outlook, maybe there's a little bit of a wedge between what the underlying factors are showing and what I think investors perhaps are expecting about the Indian economy. Turning to the medium term, I think it's fair to say that medium-term potential is promising. One should be optimistic, based, I think, on two considerations. First, I think the Indian economy has made substantial achievements, which are going to be the building blocks for the medium term. I think it's completely reasonable to speak of a double infrastructure revolution in India. India's physical infrastructure has been built up enormously. You look at all the indicators, road, rail, airports, air. All the indicators are up. Building is, infrastructure investment is surging. And complementing the physical infrastructure is, of course, India's state-of-the-art kind of leapfrogging the West digital infrastructure, which has been built up, which has allowed for, very efficient delivery for, uniform, universal government services, and also in enabling private sector entrepreneurship via building up technology platforms. So this, I think, is one big building block for the future. Again, bank balance sheets have been strengthened considerably. NPAs, which peaked about 6 years ago at 11%, have come down to 4%. And macroeconomic conditions are broadly robust and broadly stable. Inflation, core inflation is about 6%. The current account deficit is under control, and above all, reserves are at a very comfortable level. Therefore, I think there's no sign of or no prospect for any financial stress or macroeconomic stress at all. First, the potential is there because of the considerable achievements in the recent past. And then, of course, I think the opportunities that have opened up for India, opportunities that, related first of all to China kind of turning the Lewis curve, which meant that, labor skill manufacturing opportunities were opening up for other countries like Vietnam, Indonesia, ASEAN, and India. In the period immediately after the global financial crisis, India took limited advantage. This is the canonical labor-intensive exports, which are textiles and clothing. India marginally increased its market share. However, since the mid-2010s, low-skill manufacturing exports have been weak, and India has slowly been losing market share. So the first opportunity for India in this low-skill, labor-intensive manufacturing came after the global financial crisis. And of course, the second big opportunity now is because of geopolitics and the fact that foreign capital is fleeing China, seeking alternative destinations. And I think that opportunity is really very real. I'm going to talk about that in just a second. The other big opportunity for India, which has been, of course, services exports. Unlike manufacturing, we know, which is where we've certainly seen the end of hyper-globalization, if not deglobalization. In services, global opportunities are expanding, especially in digital services, as Ngozi pointed out in her Jackson Hole speech. And of course, reflecting that and combined with India's traditional strength in high-skilled services, India's exports have surged in services, and India has gained about 2 percentage point global market share in less than 2 years. So this is a very promising opportunity. And what's interesting about this is that services exports, which traditionally used to be, business process centers, writing cheap code, it's now diversifying to include global capability centers. And this is something that Pranjul Bhandari of HSBC has written very eloquently about. So this is a real opportunity. But I think what we need to keep in mind is that the manufacturing opportunity is what offers, the prospect for structural transformation, because that can absorb labor, whereas high-skilled services is going to be limited in securing medium or advancing medium-term structural transformation potential, because by definition it's high skill and it can only kind of absorb a very limited amount of India's vast labor force. Now, how is policy responding to these opportunities? I think, Josh Feldman and I have a series of foreign affairs pieces where this is elaborated upon in more greater detail. But here, I just want to mention two, I think, critical aspects of the policy response. One is the kind of the rule of law, and is Indian policy via its institutions and policies, is it maintaining a level playing field that would attract investors, domestic and foreign? So if you look at the data so far, the government investment has really exploded because the government has embarked on this major infrastructure expenditure program. But as Sajid Chinoy of JP Morgan has pointed out, private investment has not risen as yet. And despite the China opportunity that's been created, the China +1, and the very salient decision by Apple to locate in India, for some share of production in the short run, hopefully possibly expanding in the long run. So despite that opportunity that's been created, the fact is that FDI has been declining steadily. It's not expanded in line with what we would think are the magnitude of opportunities created by the decline of China. Part of the reason we think is because India is promoting national champions. There's uncertainty in the way law is administered, and that uncertainty could potentially be deterring the revival of private investment, both domestic and foreign. And unless that happens, the ability to realize this opportunity will be limited. Second, I think this is a very striking feature of Indian policy over the last 4 or 5 years, is a renewed belief in and return to inwardness, repudiating a kind of 2 to 3 decade consensus of slow and steady opening. On this chart, you see average non-agricultural MFN tariffs have gone up from about 10% to 15%, a 5 percentage point increase, in 4 or 5 years. India has, like many countries, has turned to industrial policy, uses targeted production subsidies. India has stayed out of the major regional agreements, including RCEP, even though it's been negotiating agreements with some of the smaller partners like Australia, Dubai, and now is in negotiations with the United Kingdom. And of course, most recently, and somewhat disturbingly—
Arvind, I'm sorry, we have to move it up a bit, please.
Yeah. One more slide. India has turned to import licensing and a return to the license Raj. So the conclusions, the economy is decelerating because the key driver of growth has weakened. Geopolitics and domestic achievements have created new medium-term opportunities, but realizing them will require maintaining a level playing field and certainly reversing the inwardness, because this is not going to generate 7 and 8% growth in the medium term. And the key, I think, point is that there is no inevitability from the likely decline of China to the sustained rise of India. So let me stop there and turn it over back to you, Adam.
Thank you so much, Arvind, Alejandro, and Karen. These are terrific presentations. Just to remind everyone, the slides and the videos of today will be available on the PIIE.com website events page, probably before end of day today, no later than tomorrow morning, but I believe later today. Please share them widely. They are for free download and on the record. We are fortunate to have a number of interesting questions on the Zoom Q&A function. There's still time for people to add theirs among our registered guests. Let me go in order of who the questions are directed to. Karen, Peter Heijmans asks, are you concerned about rising fiscal deficits and possible further credit ratings downgrades? Obviously, we have the looming government shutdown. What might be the impact on the U.S. economy?
Sure. So I'm very concerned about rising U.S. federal deficit over the longer term. Right now, investors seem to still have a very healthy appetite for U.S. Treasury securities, and the appetite didn't seem to be much affected by credit rating agencies' news over the summer. So I don't think it's impairing growth right now. If this were to change, if investors suddenly were to lose appetite for U.S. Treasury securities, that could be a big deal for the U.S. economy, but I'm not expecting it. I do have to say, over the longer run, it's really a different story. Debt is going to grow with the primary deficit swelling because of the aging population and increases in healthcare costs, along with interest costs that will eventually start to snowball. And we can't have that happen without a significant drag on growth from lower private investment. And, we risk fiscal crises as well. Addressing that situation is a whole, different ball game. It's not technically hard so much as making really hard choices that all have downsides.
Thank you, Karen. Very succinct. Alejandro, Charlie Kimball asks, will Latin American political outcomes lead to reforms which will alter the probable economic course? You sort of touched on this in your discussions of Argentina, Mexico, and other places in potential political transition. But could you expand on that a bit?
Yes, Adam. So in Argentina, if either Javier Milei or Patricia Bullrich wins the election, I do think significant reforms being implemented, important privatization programs, an opening up of the Argentinian economy, and obviously significant action on the tax side and the expenditure side, a significant reduction of the size of the public sector. I think in Mexico, if the opposition candidate wins, we will see significant reform in strengthening institutions, in reforming the oil company, and especially in generating a very dynamic push to the electricity sector, pushing the electricity transition towards renewables. If the candidate of AMLO's party wins, I would see some changes, but nothing called like a significant transformation.
And what about Argentina?
Argentina, I said, yeah. I mean,
I know you said Argentina, sorry, but just, I mean, it seems a little, you seemed very calm the way you were talking about it. I'm sorry.
No. Look, I think there are significant plans, huge transformations needed, and 2 out of the 3 candidates are talking about them and willing to implement it in a very urgent way. I think the problem will be having the political support and generating the consensus both in Congress and in society, because they will need to realign relative prices. Inflation will shut up before it comes down, and poverty levels are also at 40%. So I think also the possibility for a very unstable social and political environment is there as well.
Thank you for expanding on that, Alejandro. You were so tight. I just wanted you to give a bit more. And of course, there's additional writings being published by Alejandro with Peterson and Georgetown that you can look for more information. If I could, because we've got a number of good questions for Arvind, I'm going to combine 2. Arun Krishnamurthy asks, is India's big plan to foray into semiconductors a wise move, or do you think other priorities would give better long-term return on investment? And Vikram Nehru, a colleague from formerly down the street at Johns Hopkins SAIS, says it's great to have Arvind back at PIIE. I agree. He quotes you on coming to grips with the NPA program and the problem in the banking system. How did India deal with the balance sheet crisis in corporates and banks, a problem that seemed very large and an overhang on prospects a short time ago? So Krishnamurthy on the return on investment of the semiconductor push, Nehru on the NPA problem and how you feel it's been dealt with.
Yeah, let me take it in reverse order, Adam. First, on the NPA problem, a large part of it is accomplished by recapitalization and write-offs, a big part of that. Recoveries constituted a relatively small portion of addressing the NPA problem. So essentially, the government recapitalized the banks wrote off the NPAs, and that's a big part of the story. So the whole recovery part of value from non-performing assets was smaller in magnitude in terms of contributing to addressing the NPA problem. On semiconductor, I think what you will notice about this trying to attract semiconductors is that it's being heavily subsidized. The returns on this have to be enormous to justify, both in the short run and long run, to kind of justify this trying to attract this investment via this. The estimate is something like 70 to 80% subsidies for this investment. And given the fact that this is also relatively not very labor intensive, one has to remain a little bit cautious about money being spent this way by the government.
Fantastic. Thanks to my colleagues for their concision. I can get back in one more round of quick questions to Karen. We're not going to get to all the distinguished people posing questions. I would note that Eduardo Jimenez put up a point about Peru's outlook, most likely coming similar to Chile's, in response to Alejandro. Karen, two questions for you, and that's where we'll have to close. First, sorry, I want to get the names right. From Nazir Kiji, in your estimation, what effect has COVID had on productivity growth? And I would just say more broadly, in your ongoing forecasting analysis, where do you see trend productivity growth now? We've had some very chunky positive numbers lately. And also, sorry, there was one more I was going to grab. Oh yeah, you also monitor the globe. From Sylvie Duchesing, will central banks raise their inflation targets because of the energy transition? Do you see any of the major central banks raising their inflation targets soon? If you could pick up those two questions on the productivity trend in the US and more generally, central banks' reaction to their.
Yeah. So I'll go backwards. I think that the green transition, it's going to have different effects. I mean, one is going to be through government budgets. We may end up with a somewhat higher neutral level of interest rates, with government spending more money to accomplish the green transition. But I think the main thing I worry about is that it's going to raise the odds of inflationary supply shocks. Because while we're in the transition, the energy infrastructure will be less able to respond to shocks in demand or supply for energy. And that and other factors may mean it makes sense for central banks to raise their targets over the longer run, but I don't see them doing it in the near term. I don't see them doing it until they have achieved their current mission to get inflation back to current target levels. And I think the reasoning there is just that they feel like there's too much at stake with their credibility. Having been through this period, this surprising period of high inflation, they're just really worried, taking lessons from the late 70s and early 80s about the unanchoring of inflation expectations. And I think they feel like kind of messing with their targets at this point just raises too much risk of de-anchoring inflation expectations. On Nasir's questions about productivity growth, my reading of there's been all sorts of speculation. There's been the recent data, but over the course of the pandemic, productivity growth has fluctuated as employment growth has done different things. My reading of the scientific literature is that people's best guess is that there's no difference in the productivity trend relative to where it was pre-pandemic. Yes, we have remote work now, but there are questions about how much remote work actually does increase productivity. I think there are some bigger questions just over the past year have been raised regarding AI. I think that's potentially a bigger deal in terms of recent AI developments, potentially meaning that productivity growth is going to be higher than it was prior to the pandemic. But at this point, I haven't seen enough evidence to compel me to change my productivity assumptions relative to what they had been previously.
Terrific. Thank you all for joining us for our semi-annual Global Economic Prospects at the Peterson Institute. Thank you for the terrific questions from thoughtful scholars and economists and participants in markets. And as you can see, Karen, Arvind, Alejandro all bring, of course, deep knowledge and much broader thinking than they can present in this format. But we hope this gives you both bottom line up front in important areas, as well as incentive to pursue further and perhaps to question some of the other official sector and private sector forecasts out there where the Peterson Institute fellows have a slightly different point of view or a longer perspective or a more independent perspective. Probably true for all three of our scholars. So with thanks to Arvind, Alejandro, and Karen, let me call the meeting to adjourn. Of course, the videos, the slides, and I believe a transcript will all be available for free download on PIIE.com later today.